Thanks, everyone. My name is Reto Trinkler. I'm the chairman and co-founder of Melonport. And I'm very pleased to introduce probably the most forward thinkers when it comes to exchanges, decentralized exchanges, the next generation of exchanges. So please have a seat. So I'd like to start with introductions. If you could just give a brief introduction to yourself and to your project. And please especially like Lykke and Omega-1, because we haven't had talks from you.
Well, hi, everybody. Is this on? Great. My name's Alex Gordon-Brander. I'm the chairman and CTO and co-founder of Omega-1. We are not exactly a decentralized exchange, but sort of enough in the general ballpark to get a seat up here on the panel. What Omega-1 is, best to explain on 3 levels. The first thing that Omega-1 is the first automated agency broker operating in the crypto space. So in traditional asset markets, there's a lot of middlemen, and I know that's a bad word around here, but forgive me on this. There's an ecosystem of middlemen that intermediate between large clients and liquidity providers and exchanges that create a more efficient marketplace and more efficient pricing and better liquidity in those markets. So in simple terms, we're just taking that model and bringing that model into crypto. What that piece of our business model is doing is where a client has a large trade, $10, $20 million trade. Currently, you can't do that size trade on exchanges. As we saw with the GDAX crash back in July, if you try and put a big order like that on one of the centralized crypto exchanges, you can bring down the entire system. So those orders still operate entirely in the OTC marketplace. By intermediating between clients and exchanges and breaking large orders down into little pieces and then being able to trade those little pieces across all of the different liquidity sources in the crypto market, we're going to be able to bring that large volume into the exchange marketplace and create a doorway for institutions, traditional money, Wall Street types to be able to enter the crypto space. The second level of what we're doing, which is the decentralized piece, is we're going to provide a decentralized custodial experience for our clients. There's 2 different aspects to decentralized exchanges that we've been talking about here. Is the actual exchange activity happening in a decentralized fashion? And then is the actual asset custody decentralized? Because the main issue with centralized exchanges is not really, I think for most people, the fact that there's a single point as opposed to multiple validators running an exchange. It's the fact that the exchanges have to have custody of the assets. So we're providing a decentralization layer over all of the centralized exchanges on the street. So if you want to trade with us, your funds are going to be in a wallet that you control, and we'll have a balance sheet. We'll do all the trades on the exchanges for you, and then do an atomic swap from one blockchain to another in your wallet. And then the third piece of what we're doing is our token provides a crypto-economic mechanism for allocating the liquidity that our platform provides to our members. So in traditional markets, players like the Goldman Sachs of this world do a similar thing to what we want to try to do in crypto. But there are lots of backroom deals where high-frequency traders and others buy access to their order book. We're making that transparent and tokenized, so basically the more of our tokens that you hold, the higher level of access to the order book you have. So in a nutshell, that's Omega-1.
Okay, so first, thanks to the organizers for inviting me. It's actually really a pleasure to be here. And to kind of give a background about myself, so I'm a co-founder of Lykke, and I'm so happy you mentioned high-frequency trading and that, because for full transparency, I was a high-frequency trader before so I worked with Richard Olsen at his hedge fund, Olsen Limited, as a high-frequency trader. So kind of we have like intimate experience with how the matching, the order books were, how the matching engine works, and kind of like the most important part that, you know, as a trader you would very rarely think about is the settlement, you know, which in the end, you know, distributed ledgers will take a key role there. Now, so this is kind of part of how do I fit into the story. Lykke is a Swiss-based fintech company, and we have built a semi-decentralized exchange that uses the blockchain, or in colloquial terms, the distributed ledger, as a settlement system. So now I think I would first like to continue on your discussion, kind of why would you build a semi-decentralized exchange? Does it make sense? Would you like to actually go to fully decentralized, centralized, kind of you obvious reasons why it would not work? So this is actually that our experience working as high-frequency trader is that on one part, you actually absolutely need the ultra-fast matching engine, where you can do hundreds of millions transactions per second, or excuse me, per day, not so much per second, and that you don't have to actually have these issues. So we talked about in the previous discussion, there was mentioning that high-frequency traders change their orders 10 times in a second. I mean, if you ever traded, you know that NASDAQ has time stamping in microseconds. So just imagine you can change your order 1,000,000 times, you know, in a centralized matching engine. So for us, in our view, the decision was clear. Let's take the best from the existing worlds, and that's the centralized ultra-fast matching engine that can, with a clever way how you design the logic of the execution, you can actually kind of avoid all the problems with high-frequency trading, latency arbitrage, and market fragmentation. And on the other hand, you actually use the blockchain to have the assets. Because, I mean, I think you probably know all of this, the following information, that there does not exist an exchange or a trading venue on this planet that hasn't been hacked. So why? Because they are centralized exchanges. It's like you put, you know, a hat here, it's one pot, we throw our money inside, you just need to hack one thing. And once you're inside, you can do a lot of mess. So then on our side, it was clear, you know, let's take the best of the distributed ledger. The fact that it is distributed, that you can actually take assets, not so much take, you put the assets from every client and you put them in a wallet that the exchange cannot touch. So actually then hacking the exchange makes no sense, because once you do that, what do you do? There's nothing that they exchange. Likewise, if you hack the wallet, again, there's nothing to do, because the wallet needs a signature from the exchange to actually move anything. So that for us was actually a clear way how to proceed. Let's build a global marketplace for every asset that you can exchange for any other asset, and then use blockchain as a settlement infrastructure. And now, I really also like the topic that, you know, we're talking a lot about trading, exchanges, you know, ICOs, we want to issue tokens. But again, if you kind of worked in the financial industry, or if you are a high-frequency trader, you know that the secondary market is actually the most important. And you can have an amazing platform, but if you don't have liquidity, there's nothing there. Very few people know that actually the best and the fastest trading venue on the planet is called LMAX, because of the technology, and there's nothing there. You go there, it's completely empty. There's nobody trading. So the key aspect, kind of the key service that we offer, is you have the technology there, but in the end, you need somebody to be there to provide liquidity. And this is actually a key proposition in the end. Let's take the professionals, you know, we done it in a different context, in a different environment, but let's bring the best, you know, from, you know, let's bring the liquidity that you have in the FX market. They can do 100 million and not move a price 1 pip. Let's take that to the crypto world. Now, if you ask me, is that happening already? Well, it takes a lot of time to get the work done. So we're working on that.
Thanks. Yeah, so it's interesting to see that, like all of you would take kind of hybrid approach between centralized and decentralized. But I also would like to go briefly into regulation. So where do you see the differences between utility token and like security or investment tokens when it comes to listing and trading? And also, where do you see regulation in general moving towards? Maybe starting with Bill.
Sure, yeah, this is one of the biggest questions, and I think the one that always comes up for every exchange. Honestly, there is a clear distinction between the pure securities tokens which pay dividends or those sorts of things, and utility tokens. In the long run, though, we have to be honest that for the moment, utility tokens are being bought with an expectation of profits to be traded on the secondary market by investors who may not be qualified, or people who are essentially investors but not qualified necessarily to make the best decisions. And we need to be prepared, I think, that they may see, although at the moment those utility tokens seem to be safer to add, there may be a shift in that decision at a later date.
Yeah, I would just add, 0x as a protocol, we don't kind of prescribe what tokens can and cannot be traded. It's a technical standard, ERC20. If you implement it, it is tradable through our protocol. So the decision of which tokens to list lies on the relayers, and we kind of expect there to be kind of like different relayers with different risk appetites and different approaches to how they vet different tokens. But yeah, I think that is kind of an interesting kind of approach where the decision really rests with them. We as a protocol are agnostic.
Yeah, I think you have it's an interesting case with 0x because you're already live. It's already on the blockchain, and yeah, I mean we heard yesterday from Joy Krug that it can be difficult to enforce. Once it's kind of on the blockchain, then we would kind of need to shut down the entire blockchain to stop exchanges like this. So I think that plays part in, or should play part in the discussion as well. Great, maybe from you two, where do you think regulation will move towards?
I don't have much to add to what Will said, which is, there's the current regulatory approach is not satisfactory to meet the long-term needs of the regulators. I'm speaking from a US perspective particularly. The approach that the SEC's taken right now of applying Howey is probably, I have to imagine that they're looking at shifting the regulatory infrastructure to cover utility tokens over time, but don't have a good framework to do it. Our approach is we believe over time we're going to need to be a FINRA registered broker-dealer as well as being a money transmitter, and that's just kind of a painful load of regulation to deal with, but that's just the cost of being in the game.
Right.
So, again, for full transparency, to mention that Lykke, as far as I understand, is still first and only company that actually puts shares on the blockchain. So when you buy Lykke coins, you're buying, now disclaimer, a liability on shares. So why did we do that? And that was way back in 2014, is because we went to FINMA, I don't know how many times, too many times, and we asked them, how do we can structure the token on the blockchain such that we don't have problems with you? And the answer was very clearly, it has structured as a financial security. From day one, say this is a financial security and do the hard work. Let the lawyers burn a huge hole in your wallet, let them do that, but structure it in such a way that you will never have a problem with anything. So that's what we did. And strategically, our decision is that my biased thinking is that the regulators will just declare everything a financial security. So whoever is now playing the network participation game, utility token game, you will lose in the end. Because they will pierce, the structure where you have, the service provider, the ICO entity, and we cannot even call them investors. They're contributors. These are contributors in the ICO world. This will be pierced, and then they will go after the people who did that. This is kind of my biased opinion, and a strategic choice for Lykke is to going forward will not pursue utility tokens, because just if you want to get, I'm mentioning broker dealer license. If you want to be an ATS or an MTF or whatever kind of structure you want, playing the utility token game will not work long term.
Thanks. So maybe expanding a bit on this, and especially on, the last point to regulation, and then we're going to skip to another topic. But traditionally regulation kind of applied on kind of the membrane, and that maybe affect Alex and Anton. But for completely decentralized exchanges or semi-decentralized exchanges, it's a bit different. And So kind of where do you see like stablecoins play a role? Because stablecoins are really a way to have like assets that are correlated with the current economic system, kind of, and not be exposed to the volatility of crypto. It's kind of a way to, I guess, still have like stable currencies. Yeah.
Well, just one thing about the membrane. I mean, one of the things that we're looking at is obviously there's an AML KYC question. Sort of, there is a membrane of who's holding the assets as well as who's actually interacting on the exchanges. And I think we could easily see a situation where we don't end up necessarily with security classification for all of these tokens, but we still end up with a sort of a requirement for permanent whitelisting and a token that can only be traded among whitelisted addresses. And I think there's a lot of interesting development in things like Uport or other sort of general identity and attestation solutions to create a unified KYC framework for blockchain assets, because if every issuer needs to create its own KYC framework, which is roughly the situation at the moment, that's just a huge frictional drag on the whole ecosystem.
Right.
I mean, just to mention that regards to the stable coins, I definitely think that's an amazing idea when you can actually map something from the old world to the new world and kind of reap the benefits of technology. But again, I mean, stable coins depend on liquidity. If you don't have liquidity, these things don't work at all. So, and I can just recall you, I mean, if you remember the May 6th flash crash, where you had the futures trading, the E-mini futures trading on one side and the ETF, 20% lower. But this is the same thing, actually. So what happened in between? How can that happen? Because there's no liquidity actually there. So I mean, if you ask me what's the model going forward, I would argue like this, that it actually already exists, and it's in the form of the NASDAQ pink sheets. So the pink sheets are basically the way how to kind of list shares of companies, but don't go through the complicated procedure. So I think going forward, at least in US, Europe will probably adopt the same model. You will have a private placement model where you actually have the nice technology, the blockchain, and then you will have kind of alternative trading system, and the regulatory setup will be kind of similar to the one of pink sheets. This is how I see it going forward, because that way, young startups can actually list their shares, raise capital, and not bankrupt in the procedure, which is actually what the ICOs enable, that you don't bankrupt starting the company.
Okay. You want to say something, Will? Expand on this.
Yeah, I guess I'll say as well on both points. So Bitfinex and Ethfinex are both essentially unregulated exchanges. They have money transfer licenses in certain jurisdictions, but in terms of actually being regulated as an exchange, they've have taken a strategic decision not to be regulated in order to be able to add these tokens. But the long-term view will always have to be that it will need a securities trading license, especially. So we've now closed off to the US in the short term, but in the long term, it will need those licenses in order to ever operate there again.
Okay, thanks.
And then just one comment on the stablecoin thing. It's like stablecoins are one of those things in blockchain space that seem incredibly simple, and why isn't that already out there? And then you start digging and you look at the solutions, whether it be MakerDAO or Stable or whatever, and things get incredibly complicated, and there are pegs, and what the hell's going on there? And the issue is basically that if you're pushing the fiat crypto boundary to the stablecoin kind of maker, and they're responsible for then dealing with the liquidity across that boundary and dealing with compliance across that boundary, there's a cost on them for doing that. And so it's just not easy to create a completely frictionless stablecoin situation where there is actual friction in the system that is going to sit on, that cost going to sit on somebody, and then still have it be at price parity. There's something just doesn't work there.
Right.
Can I just add one thing? I think this is an amazing topic, having a stable token. And the most famous, in my view, stable token was the Euro-Swiss franc peg. So a central bank pegged, Swiss francs to euro, central bank that can print money at will, and how that ended up, they were afraid when the peg dropped that it will hit zero, So this is an amazing topic, but if the central bank cannot handle it, I do not see, an easy solution. There's a lot of smart people here, but I don't see an easy solution how we can handle liquidity, in stable coins, no matter what you say, actually. Very interesting.
I mean, the easy solution is the day that the Fed and the Bank of England and the Bank of China and everyone else issue their own cryptocurrencies. And we're not that far away from that thing, but we're still kind of a few years away from that thing.
Or anyone else, essentially, any trusted authority. Might be a central bank, but might just be like an independent company that has some reputation. Of course, the value of the stablecoin then depends on the reputation of that company, but it can be technically quite easy, I guess. Great, so next topic is scalability. I'm sure a topic you've all thought extensively about it. You all took like different approaches, what I perceive to be like an effort to solve kind of the scalability and the security trade-off. So could you maybe just outline your approach and like the benefits, the pros and cons to your approach?
Yeah, sure. So scalability and security. Yeah, so scalability, I think what was really important for us was to store as little information as necessary on the blockchain. We know that is going to be, like blockchain capacity and a block capacity is going to be our bottleneck. So all that we store is the order hash to the amount of the order that has been filled or canceled. The rest of the information is either in an event or off-chain. That being said, like there's still going to be performance limits. And so what we are looking at internally is, exploring other blockchains options that might be able to relieve some of that scalability issues. And we're also keeping very close tab on the Ethereum Foundation's kind of scalability roadmap. In terms of security, I mean, I think one thing that's really cool about 0x is, anyone can build a decentralized exchange, but none of them are holding users' funds. And that's really, really cool because, quite frankly, most people don't want that responsibility. And they shouldn't have it. Who is holding the funds is a smart contract. Because we know that the technology is going to evolve and develop, we need a way to update that smart contract. And that obviously introduces the potential risk that this new contract could be a malicious contract that tries to steal users' funds. And that's why we're working on a governance system where there's essentially a kind of like a financial incentive by the token holders to do the right thing, because if they don't, the value of their token goes to zero. So that's kind of one aspect to it. And another one for the time being is also that any change that is made to the 0x protocol has to go through this time lock window where anyone can audit and see the open source smart contract, read it, and if there is something malicious in it, withdraw their funds and avoid some sort of loss.
Okay, so on the same topic, the way that we're going to approach scalability issues is that, so decentralized exchange, for example, using 0x, which is one of the protocols, which is the main protocol we're going to use to begin with, is great. I mean, right now you can settle trades securely without taking any risk, without users taking any risk of their funds with third parties on chain. The problem is using the main chain, Ethereum in this case, does pose huge scalability issues. You can do a maximum of, say, 5 to 10 trades per second or per block. And that's really going to not be long-term scalable for any decentralized exchange where you may want to be matching many thousands of trades per second or hundreds of thousands of trades per second. So the solution here is going to involve not using the main Ethereum chain for settlement as far as we're concerned. It will involve likely a child chain, which would be almost a separate blockchain, but still enforced to the Ethereum network and you only need to put a transaction essentially in the case of disputes or issues like that. And that's the kind of approach we're going to be aiming for. And really, even that in itself might not be scalable enough for the kind of level of trading which one day we expect to see in this space. And so even that chain itself will need to be designed specifically for decentralized exchange, just to be the most efficient input-output system that you could possibly have for transactions without thinking about all the other potential use cases you might want for blockchain, and really specializing it as something specifically for this use case.
Fascinating. So it's like almost its own chain, or it's like, yeah, I guess. But like the three of you all have like the settlement layer on the blockchain, and I'm wondering you mentioned kind of Polkadot and this as a potential scalability solution, but it could also be like a potential chain for exchanges. But I'm kind of wondering like since your settlement layer is on Ethereum right now, have you thought about integrating other assets from other blockchains into your exchanges?
0x specifically?
Yeah.
So not in the kind of immediate timeline. I think what we're waiting for is these relay chains to kind of link up the different blockchains. There are a lot of people who are doing kind of like pegged zones and Cosmos and kind of ways where you can release funds on one chain when funds are received on another chain. But until we have these relay chains, the only way to do it is in a centralized way, and we don't want to go that route.
I mean, so I actually also get asked this question a lot, and kind of I usually tell people just whatever problem you think there is, there actually isn't. So in just everything will be solved, and it's the same like complaining that the camera on your smartphone in 2007 was not good enough. I mean, no, things will be improved. So this is kind of my argument. The way that Lykke solved the issue was through the implementation of Lightning Network. So just to kind of keep it to that. But now I like to be very provocative usually. So I will just kind of state kind of how do I see the problem is that. The problem is that the settlement cannot be fast enough because the entities have to do the hard work, to verify that the transaction is basically in order and you can swap the assets. If you go and read the white paper about Bitcoin, the blockchain, there's actually one sentence that says, let's assume that the entities that maintain the blockchain, I'm paraphrasing, cannot be trusted or do not work in the best interest of the blockchain. So that's the problem, actually. You don't want people to mess up with the database and then they swap assets or they double spend. But let's now be very, very provocative here. What if you can actually trust the entities that swap the assets? What if you can trust the miners that they will not do anything bad? Do you actually then need a complicated verification procedure? They know that takes a lot of time. The answer is obviously no. So kind of very provocatively to say is that the blockchain of the future is still distributed. You will have entities that will maintain it, swap the assets. Now, who can you trust in the end? So maybe this is now the provocative part, is that those will be the financial institutions, the broker dealers, the fintech companies who will kind of get a license or an approval, and they will be able to swap assets on a global database. Then you actually realize there is no scalability issue, because if I trust you, just settle it. You don't need to actually check anything, you don't have to do complicated work. So this is kind of my provocative opinion, and I'm quite sure I raised the pulse of many people here in this room.
Thanks very much. I think another interesting trade-off is a trade-off between privacy and transparency, especially preventing front running and having kind of this leveraging of this open ledger and have maximum transparency. So if you could just give me your take on it, and if you had to pick privacy over transparency, which one would you pick?
So I'm going to just hit a couple of the backed up previous questions as well, because they're all met with the same answer. We're mostly tooling ourselves for being able to do large transactions. And so if somebody comes in with a $10 million size transaction, and we end up meeting that with kind of 1,000 small transactions on the exchanges, we're basically going to be handling those transactions in off-chain settlement in our own books in a centralized form, and then doing a single atomic swap of the large transaction, and that helps to handle the scalability issues for settlement. It also means that the individual transactions that are happening, and we use our own balance sheet to do those transactions, so we're shielding our customers from risk in that situation. And similarly, from a privacy transparency perspective, the important thing for avoiding front running is if there's a very large order coming through the platform, you don't want transparency on that order in process transparency at the end of the order is not so bad, and so we'll keep the order private during the order. As ZK snarks and more privacy comes in, obviously we're going to actually provide a higher level of obfuscation throughout the entire process. But we want to have a chance to see that technology operate in production and with good performance before we try to integrate that into what we're doing. In general, it's a really good question about the balance between transparency and avoiding front running, because obviously if you're a client and you're doing an order, you want to see transparency in how your order's going. But also if you put spoof orders in, seeing transparency on that is also going to give you information about other people's orders on the exchange. And our general approach on that is to lean into transparency first, and try to measure front-running risk, and then scale back transparency as we need to reduce front-running, because we'd rather lean towards giving users control and understanding of what's going on than obscure that information from them.
Yeah, in the case of 0x, it really depends on the relayer and the strategy that they want to use. There are certain strategies that they can use where they can completely avoid front running. Actually, Ethfinex is going to use one of those, which is a matching strategy. 0x lets you define who the taker can be for your order, and you can either say anyone in the world, or you can say Ethfinex, and then they can go in and they can be the only ones who can match the orders, and that completely eliminates front running. But it has the downside that it's much less of like an open system that is permissionless and that can enable kind of these DApp use cases. So I kind of see, I think we're going to see a whole bunch of different relayer strategies, and they're all going to tailor to kind of a different type of investor and a different kind of use case. And if what you care about are kind of like smaller transactions that just enable people to do token abstraction or inject these orders into a smart contract, then you can go with like an open order book and kind of take the risk of front running because it's not very high. But if you're doing like a very, very important trade, maybe you'd go with kind of a matching approach.
Thanks.
So I actually love talking about this topic, coming like from my professional background. And I'm not sure if you actually know that kind of the explosion of high frequency trading emerged in 2007. And the question is, what happened so amazing in 2007? One part was regulation, linking up fragmented markets. And the other one was actually figuring out that you can arbitrage the logic of a matching engine with special order types. This is what the bad high frequency traders try to do. So if I'm a market maker, my job is very simple, provide liquidity, but avoid latency arbitrage and avoid toxic flow. That means in normal language, just don't trade with Goldman Sachs and smart people, So basically, every trading venue on the planet, just like all here, operate on a price time priority. That means, the first attribute to determining which order goes first is the price, the second one is the time. And it turns out that with special order types, you can arbitrage this logic. So that's why if you're a high-frequency trader, you go to exchange, they give you a book with 250 pages full of order types that you can use. This was strategically done. So, but if you try to think about how can we avoid being gamed by high-frequency traders, it's actually very simple. You need to change the logic of the matching engine. You have to actually include the spread as an attribute into the matching engine. Because why? Because the market makers care about the spread the whole time. Then they're the ones actually setting the spread in most cases. So the way you solve this issue is you take first attribute as price, second one as spread, and the third one actually as time. So very gently and very subtly, it's very hard to figure it out, that you actually give priority to market makers. And then, the whole game around high frequency trading and front running and latency arbitrage actually just goes away. So, the solution can be very subtle if you actually understand, that the problem was kind of goes in that direction. So I think, just kind of like if we really think about it, we realize, okay, the problem is the matching engine, not the settlement system. It's not the blockchain thing. So then when you change the logic there, you can actually solve a lot of these issues.
So to look at it from a bit of a different perspective, for decentralized exchange, a fully scalable decentralized exchange, the real difference I guess will be transparency, but only with a time delay. So for example, you have certain settlement points, and between those points you can provide a tree of every transaction that's happened and every and the history of those trades, but with, say, for example, user identities or obfuscated, and provide open source tools so that users can post-verify that all the trades that should have happened between those two settlement points were correct and did happen. So that's also another simple way if we are using fully on-chain settlement, that you could compromise between those two different points.
Just one thing I just want to add, when we talk about front running, there's really two different kinds of front running to look at. In the situation where somebody has a large amount of flow that they want to move, the simple front running is an order's coming in, and someone sees the order and is able to stick an order in front of it, and sort of on the individual sort of small piece, they manage to get in front of it. Then there's the other type of front running, which is there's large amounts of flow moving, and somebody sees that flow and tries to get ahead of that flow. And that's where I think what Will's talking about, sort of there's issues around obfuscation of data and settlement even after the point that the individual trades have been made, that is still important to create safety for larger players to be able to operate in the space.
Thanks. So I have one more question, and then I think we have some time for the audience for questions. So my last question is, it's very interesting, you all kind of took different approaches in providing liquidity. So could you just maybe explain briefly what's your approach in providing liquidity and how your service or your exchange is going to replace NASDAQ?
So we've got I guess our approach is to split our user base almost. So we'll have a centralized exchange which caters particularly to low latency trading, where you may not actually have much capital at risk, but placing high volumes of orders and providing liquidity to the market, combined with this initially decentralized exchange, which is coupled with it, where users who want to place much larger orders but on a slower time frame can place those without taking any counterparty risk and add them to the same order books. But the longer term approach will be to make this very open so that all other exchanges, both centralized or decentralized, can link into those order books. And in order to incentivize that, that's where our Nectar token comes in, where essentially we want the largest users of this exchange to be its owners. So the more you trade as a market maker and place liquidity into the order books, the more of these tokens you will earn, and essentially you'll then become an owner of the exchange. And we hope that that will incentivize and bootstrap liquidity.
So I would just like to make a philosophical statement about Lykke, is that we offer an equal playing field and the same terms to everybody. Because I'm saying this because I was actually part of the high-frequency trading community, and you would see that the mess that people have created, in a sense that you would give a call to the exchange and you would tell them, please put me on a different port, and all of a sudden you have a lot of different, you see the markets a lot different and a lot faster. So we don't want to give favors to anyone. So I do not see going long-term that people will accept an environment where you have one group on one side, you have the high-frequency traders, the institutional investors, they get special terms, and then you have the retail getting different terms. I think that philosophically people will kind of long-term will not accept that. So I think going forward, you just need to offer the same amazing terms to everybody. And that's actually doable. This is not, you can have a profitable business model offering great terms and conditions to everyone. And this is how Lykke will go forward. And a lot of these things, how we will do it is what I mentioned with this, the matching engine will actually work a lot different. In the background, you will always actually have a separate Lykke asset management company that will have enough capital when the prices overshoots that we step inside and provide liquidity. So this is just a clear-cut model how we see going forward. And I think that's, just long term, this is the winning way how to proceed.
So for 0x, there's kind of two aspects to it. The first is that we're native to the blockchain. So whenever a new token is launched, it's like immediately tradable on a 0x enabled exchange. which is really exciting because it's kind of like this permissionless innovation space. The second aspect to it is just making it drastically easier for anyone to start a relayer, a decentralized exchange. And since they're all built on top of 0x, they all follow the same rules, they all have the same order format. And so all the relayers that take the open order book kind of strategy will be able to pull liquidity from each other. And if you start a new relayer, you can pull all the liquidity from existing relayers and bootstrap your own liquidity. Yes, you're not going to earn the fees if those orders get filled because the fees will go to the original relayer, but someone comes to your site and they can immediately start trading and they don't have this liquidity issue and this chicken and the egg problem. And so we think these two forces are going to solve our liquidity problem.
So our approach to providing liquidity is it's very hard to start a new liquidity venue from scratch. The network effects in trading are greater than they are in social networks and other places. You know, a social network where 10 of your friends are there can still be useful. An exchange where 10 of your friends are there just probably isn't. And so we're starting with the premise that we want to connect to every liquidity source that exists in crypto on the planet and make it easier and safer for our clients to access all of that liquidity through providing low-cost aggregation and powerful algos that allow people to interact with all of the order books in the world in a more efficient way than they'd be able to themselves.
Thanks. So we have 3 minutes left. I'd like to open it up to the audience. If there's anyone that has a question and would like to address to these guys.
Hi, a question for Lykke. I trade daily and I put in limit orders now since you offer those. And sometimes the spreads are quite wide, and I know you do some of the market making and I see how the spreads tighten as volatility decreases. And that's, I think, almost always done by Lykke. The question that I have is, how do you plan to bring in more external liquidity or external non-Lykke liquidity, especially in the currency pairs that are relatively illiquid, like LKK1Y?
So just to answer, I mean, I'll give you first a reference actually, and then a clear-cut answer. If you go to all the trading venues on the planet, regulated ones, when we trade normal assets, and you look at order books, okay, and you collect, all the orders, and you just look how much capital do you need to put all of these orders in the order books, and then you realize that does not exist money on the planet to support those order books, and then you can wonder how can that happen, and the answer is very, very simple. It's leverage. So liquidity and leverage are tightly connected, okay? And the way you can offer a lot of liquidity is by having the capability to expand and contract your balance sheet. So if you're asking me, why is it the case that the spread is now not 1 pip at Lykke, it's very simple, because we do not have the license to take on credit, okay? So, once we have all the appropriate license to be a broker-dealer and to trade financial security, at that moment, we can, expand our balance sheet, and the spread will contract to 1 pip in the next day. So it's pure regulation. I would love to do that, but we just don't have the capacity to take on the leverage to offer you amazing liquidity. Pretty much that's the answer.
Thank you.
Who was it? Hi. How would you explain this new type of exchange to people working still in the old-fashioned asset management industry? Like the one sentence, what's the main difference?
Are you asking that of each one of us?
Yeah, please, go ahead.
Yeah, I guess for 0x, I would say we're breaking up all the different pieces that used to be performed by a traditional exchange, and we're giving each piece to a different kind of player in the ecosystem. And we think that this will make it more efficient and also more secure. And yeah, I mean, obviously I would have to go into detail.
So I think these are exchanges which, as a general rule, are aiming to be more transparent and have lower barrier to entry than any traditional exchange, and also to be open to these new assets for the moment, although I think intending in the long term to move to more traditional assets as well.
I mean, really, I would kind of give an analogy to answer this question is that the same way that, you know, internet changed the way we can access information in a sense that it's universally accessible and it's a global platform and anyone can access anything, the blockchain will do the same thing for assets. You will have one global platform with any assets you can imagine, and you'll have a marketplace where anyone can access these assets and exchange them. So literally, you know, I see the global markets as the internet and being powered by the blockchain as technology. This is what it is.
What he said.
Thank you, Reto. Check. Thank you, Reto. Thank you, panelists. Very insightful and interesting. Next up is Matthew Di Ferrante from the Ethereum Foundation, and he'll be talking about ways to prevent decentralized exchange front-running by design.